Everyone is predicting a massive housing crash. Real estate YouTubers, financial media, even some economists are calling for 30 to 50% price drops nationwide. They're pointing to high mortgage rates, affordability crisis, economic uncertainty, and saying this is just like 2008. Get ready for the collapse. But here's the problem. They're completely wrong. And if you base your investment decisions on this flawed analysis, you're going to miss the biggest wealth building opportunity in residential real estate in decades. I want to show you exactly why the housing crash narrative is fundamentally broken and what's actually happening in real estate right now. I've been analyzing real estate markets for over a decade. I've personally underwritten hundreds of millions in residential and commercial transactions. I work with institutional investors, family offices, and private capital groups who are actively deploying billions in real estate right now. And if you want the real analysis that cuts through the media noise and that shows you what's actually happening in housing markets, hit the subscribe button, because what I'm about to reveal will completely change how you think about real estate investing for the next 5 years. So let's start with why everyone is getting this wrong. They're using 2008 as their reference point and assuming that high prices plus economic stress equals housing crash. But 2008 wasn't a housing crash because prices got high. It was a housing crash because of what created those high prices. In 2008, we had a massive oversupply of housing. Builders were constructing 2.1 million new homes annually. Banks were giving ninja loans, no income, no job, no assets to anyone with a pulse. People were buying houses they couldn't afford with adjustable rate mortgages that reset higher after 2 years. The entire system was built on unsustainable credit and artificial demand. Today's housing market is the exact opposite. We're not dealing with oversupply. We're dealing with the most severe housing shortage in modern history. We're not seeing loose credit standards, mortgage qualification requirements that are the strictest they've been in 40 years. We're not seeing speculative buying with exotic financing. We're seeing cash purchases from qualified buyers who are competing for limited inventory. The fundamental supply-demand dynamics are completely different. And that's why everyone's predicting a 2008 style crash is going to be spectacularly wrong. And let me show you the actual data. Here's a reality that crashes predictors are completely ignoring. The United States has a housing shortage of 3.2 million units. That's not my opinion. That's data from Freddie Mac, the National Association of Realtors, and every major housing research firm in the country. After 2008, home builders got completely burned. Annual housing starts dropped from 2.1 million units to 500,000 units in 2009. And they stayed historically low for the next decade. Meanwhile, population kept growing. Millennials, the largest generation in history, started forming households. Immigration continued, but we weren't building nearly enough homes to meet that demand. From 2010 to 2020, we needed 1.5 million new homes annually just to keep the pace with population growth. We built an average of 1.1 million. That's 400,000 units annual shortfall for 10 straight years is how we ended up with a 3.2 million deficit. And here's what's happened. We're still not building enough. Even with construction ramping up in 21 and 23, we're only hitting 1.4 million units annually. So not only are we not closing the gap, we're still falling behind by 100,000 units every single year. Now tell me, in what universe does a market with 3.2 million units shortage experience a massive price crash? It's economically impossible. But what about mortgage rates? The crash predictors ask, 7% mortgage rates will destroy demand. Let me give you some perspective. 7% mortgage rates are historically completely normal. The average 30-year mortgage rate from 1971 to 2000 was 10.9. The 3% rates we saw in 20 to 21 were the anomaly, not 7% rates. We had emergency monetary policy for a global pandemic. That wasn't a new normal, it was a temporary stimulus. But here's what's really happening with mortgage rates. High mortgage rates aren't destroying housing demand. They're changing who can buy and how they buy. Cash buyers now represent 30% of all home purchases, up from 20% in 2019. Who are these cash buyers? Baby boomers downsizing with equity from their current homes, investors with capital to deploy, high-income professionals who can afford 7% payments. These aren't desperate sellers. These are well-capitalized buyers competing for limited inventory. Now here's where the analysis gets more nuanced. Not every housing market is the same. The crash predictors love to paint with broad brushes and say housing will crash everywhere. But that's not how real estate works. There are markets that will see price corrections, and there are markets that will continue appreciating. Markets that will see corrections, overbuilt Sunbelt metros like Austin and Phoenix, where population growth has slowed and new construction exceeded absorption. Markets that will continue appreciating, supply-constrained regions like California, the Northeast, and secondary markets with strong job growth, and limited development capacity. So take Virginia as an example. Richmond and the Hampton Roads have strict environmental regulations that limit new construction. Population growth from DC spillover and data center development is accelerating. Housing inventory is at historic lows. Average days on market is 18 days. Multiple offer situations are still common. This doesn't look like a market preparing to crash. It looks like a market with structural supply-demand imbalances, and these that support continued price appreciation. But here's where this gets really interesting for investors. Even if single-family home prices experience modest corrections, in some markets, multifamily rental properties are positioned to benefit dramatically. Because here's what high mortgage rates actually do. They don't make people disappear. They turn potential home buyers into renters. A 28-year-old making $85,000 who could afford a $400,000 house at 3% rates, but can't afford a $250,000 house at 7% rates, they don't vanish. They become high-quality renters with good income, stable employment, and a strong desire for quality housing. These are exactly the tenants that multifamily owners want. Young professionals with growing incomes who will sign long-term leases and tolerate modest increases. And the data supports this. Apartment rents in most markets are still growing 3 to 6% annually. Even with economic uncertainty, vacancy rates remain below historical averages. Class A properties in strong markets have waiting lists. So while crash predictors are focused on potential single-family price corrections, smart investors are recognizing that rental housing demand is accelerating regardless of what happens to home prices. But don't take my word for it. Let's look at what the smartest capital allocators in the world are actually doing with their money. If housing was about to crash, would institutional investors be deploying record amounts of capital into real estate? Blackstone just committed $30 billion to real estate investments. Brookfield raised $15 billion for North American real estate. Starwood Capital is targeting $10 billion in acquisitions over 24 months. These aren't emotional decisions by amateur investors. These are calculated deployments by institutional teams of PhD economists, market researchers, and data scientists. They have access to the same crash predictions that everyone else is reading. They're analyzing actual supply and demand fundamentals instead of extrapolating from 2008 or getting caught up in media narratives. And their capital deployment tells you everything you need to know about where smart money thinks real estate is heading. So let me give you one more piece of the puzzle that crash predictors completely ignore. Demographics. The largest generation in American history, Millennials, are in their prime household formation years. 78 million people between ages 25 and 40 who need housing. Gen Z is right behind them, another 72 million people entering the housing market over the next decade. The Census Bureau projects 1.2 million new households will form annually through 2030. Each household needs housing. Either they buy or they rent, but the need for housing units doesn't disappear because mortgage rates are higher. This is the fundamental demand driver that supports housing markets regardless of economic cycles. Population growth and household formation. So what does this mean for you and your investment strategy? First, stop waiting for a crash that isn't coming. While you're sitting on the sidelines waiting for 30% price drops, institutional capital is acquiring the best assets at today's prices. Second, focus on supply-constrained markets with strong demographic trends. Look for metro markets in metro areas with limited development capacity, growing employment bases, and below average housing inventory. Third, target multifamily properties that benefit from home ownership affordability challenges. Class A and Class B apartments in strong submarkets will see sustained demand for high quality renters who can't or won't buy homes at current prices. Fourth, structure deals conservatively. Use moderate leverage, maintain capital reserves, and underwrite to current market conditions rather than optimistic projections. The opportunity is real, but it requires disciplined execution and realistic expectations. The housing crash narrative is appealing because it's simple. High prices plus economic stress equals crash. But real estate markets are complex systems driven by supply, demand, demographics, and capital flows. The reality is that we have a structural housing shortage, historically normal mortgage rates, strong demographic grind, and institutional capital validation. Now, this doesn't guarantee that every market will appreciate or that there won't be regional corrections, but it does mean that the broad-based housing crash that everyone is predicting is extremely unlikely. If this analysis changed how you think about housing markets, smash that button and subscribe for more real estate intelligence. Drop a comment and let me know, what markets are you watching for investment opportunities? Are you seeing the same supply constraints in your area? Because while everyone else is waiting for a crash that isn't coming, the real opportunities are happening right now. And don't let the media narratives and flawed analysis keep you from building wealth and the strongest housing market fundamentals we've seen in decades.